All right. Good morning, everyone, or good afternoon, excuse me, depending on where you are in the country. This is Steve Santos here with Best Agency USA. We're a brokerage general agency located in Boca Raton, Florida. We're really happy to have you here with us today. Our presentation today will be done by Marty Smith, Regional Vice President from Security Mutual Life. He's going to talk about the infinite banking concept from Security Mutual's standpoint, and something that Marty's very passionate about that I just found out as we were getting ready to start this call. So we're looking forward to a great presentation. And without any further ado, we're going to kick this right on over to Marty. So Marty, the floor is yours, sir.
Oh, well, thank you very much. Thank you very much, Steve. What I'm going to do is share my screen right now. And excellent. Let me minimize this so I can see all the numbers that are going to come up. My name is Marty Smith. I am the Regional Vice President of Security Mutual Life. I'm here on this call with my good buddy, Steve Harling, who is also the Regional Vice President. I believe he is the Regional Vice President for Steve and for all of you guys here on the call. Today, I'm going to go over what we call the infinite banking concept. At Security Mutual Life, life insurance companies, well, we just don't like we don't like using the term bank or banking along those lines. So we came up with this other title many, many years ago. We call this capitalized whole life. And I think you'll understand the way that we actually design the policies, design the banking type policies, that you'll understand exactly what we mean by that. But this is the main book. If everybody can see this, this is Nelson Nash's Becoming Your Own Banker. It is the Bible of this concept. If you haven't read that book, I would urge you to do so immediately. In fact, that is the way that most sales were made in the past and continue to be made and currently by people selling that book and then talking about the concept. Because once people read that book, if they have, as we like to say, if they have any sense at all, they get really excited about, oh my God, is this how money really works? And that's what we really talk about here. So today, let me do this presentation. I've been doing this presentation, I'd say, in the beginning, right from the start, once I understood what the concept was 18 years ago. And then this formally came into being at a presentation I did at Security Mutual's wonderful president's cabinet for our top general agents, top salespeople. And I'm going to use that. Now, obviously, it's a product that was used, that doesn't exist right now. There's different versions of the whole life that have been there. But again, the whole idea about this is the concept. This is what I want you to see. This is what I want you to understand. And Steve and I are going to go over this in pretty much detail there, and it can go pretty fast. So hold on to your questions there. We'll be plenty of time to answer them as we go along. This is my contact information. If you need it, that's my phone number. And that's my email address. If you want to get in contact with me directly, I'm happy to answer any questions along those lines. I'll put this up at the end so you can see. All right, so let's begin. What we like to say at Security Mutual Life is that life insurance, especially dividend paying cash value whole life insurance, is first and foremost a death benefit. You should never discount how important that death benefit is. In fact, the only way you can become your own banker using this concept is by using life insurance. It's the death benefit that makes this work. And let me tell you, when you get to be an old person such as myself, with my gray hairs here and my experience, you'll realize that that death benefit becomes certainly the most important part of this contract at the end. So that's never discount how important that death benefit is. But the second thing about that is if you're still alive, well, guess what? Life insurance becomes a deferred asset, meaning if you have this whole life insurance, what is it? Well, it builds cash value. And what does that value become? Well, that's the deferred asset that you tax-free retirement or cash money, say, create a income at a point in time because of it. It's secure life to capitalize in an asset. And the story takes place almost over 10 years ago. I have a 30-year son at the time, whatever, and we were talking about this. And I said, son, hey, what do you think uh, now? About the way things are going. I said, well, you probably might be right about that. I said, well, what about taxes? Do you think taxes in the future are going to be up, down, or stay the same as they are now? He says, think about this. 10 years ago, the national debt was below 20 trillion. So even at that point in time, my son said, no, I believe they have to go up. They have to get paid. So I said, think about this. If Social Security is not going to be around and taxes are going to be much higher than they are in the future, what do you need? Well, you need to put money away as much as you can, as quick as you can, as fast as you can, for as long as you can, in order for you to replace that, in order for you to create your own type of private pension. We don't like using that term. Your own replacement for Social Security, your own additional supplemental retirement income for yourself when you can't work, if that comes to be. So you need to do this right now. And especially if taxes, you need to put it in a safe, protected place where you may not have to. Oh, that's a value whole life insurance policy. So let's take a look at the policy I created there. And now, normally, if I was standing in a crowd, I would be talking to people there, but I'm going to talk to Steve Harling as if he was my son. So Steve, son.
Yes, Dad.
So, son, this is what we're going to create for you. Right now, you and your wife can put away about $1,000 a month or $12,000 a year. In order to create a capitalized whole life policy, and in order to create money that you can have access to sooner rather than later, we're going to create a base policy with a base policy face amount of $500,000. The premium for that is going to be, $4,300. There's the $75 policy fee. And then what we're going to do is we're going to add a paid up additions rider. That paid up additions rider you see on the screen there, it's $7,615. And what is that? And what is that $7,615 going to do for you immediately?
It's going to go in my cash value.
Well, it is going to go in your cash value, but immediately take a look on the screen and you see that it's going to provide a death benefit immediately for you as a male, age 30 standard of $40,774. So the total death benefit right there is $540,774 for $12,000. Not bad. So the question is, well, what does that look like if you look at an illustration? What's going to happen? So we're looking at the tabular detail. This is what we call our LP 121 product. It has the lowest premium for the highest death benefit. So what we're going to do is we're going to put that $12,000 into the policy. After 10 years, we put in $120,000. All right. Steve, what is the guaranteed total surrender value after 10 years?
$120,217.
Well, how do you like that? Every dollar that you put into this policy shows up where? Back in your pocket. Unbelievable. Unbelievable. And look at this because of the paid up additions, what the paid up additions continue to do. Your total death benefit when you started was $540,770. But on a guaranteed basis, Steve, what is the total death benefit in year 10?
$853,774.
So that's already grown $300,000 by just putting in that extra $7,000. $7,600 over the course of that 10 years. And it's only going to get improved better and better. If we look over on the non-guaranteed side of the ledger there, you'll see that what's the total surrender value in year 10, Steve?
$128,228.
That's right. Now, the thing about the 121 product that Security Mutual is, we built everything into the guarantees, right?
Mhm.
So if you had our traditional product, whatever, the dividends might be higher, but the guarantees would be lower. In this particular product, the actuaries, because they're a crazy group of guys, said like, well, make this different. Oh, we'll put it in the guarantees and lower the dividends over here. Are you in a better position if the guarantees are higher and the dividends are lower over here? I believe so. Definitely. Because of the dividends, whatever, your total death benefit is up to 882,000. All right. Now, Steve, now my son, they need more death protection. In what year does the total death benefit non-guaranteed become $1 million?
Down there in year 14.
Year 14. Think about that here. We started with a $500,000 base policy. 14 years later, we've almost doubled it there. Pretty cool. Pretty cool. So now what are we going to do? Well, I said to my son, you got to pay premiums as much as you can, as fast as you can, for as long as you can. So what we're going to do is we're going to pay this from age 30 to age 70. So that's 40 years of paying premiums. So Steve, based on the current dividend scale that was there at the time, what would the non-guaranteed total surrender value be 40 years later?
$1,245,084.
All right. So we started with 0. We put in all our premium, whatever, and we're sitting on 1.245. Is that a good deal or a bad deal?
I'd say it's a great deal.
It is a great deal. That's what that was what I was hoping you would say, son. And look at the death benefit. Oh my God, what happened to the death benefit? We started out with a $500,000 base premium. And what is the total death benefit based on the dividend scale at that time? What is it now?
$2,086,329.
Wow. 2 million bucks. Can life insurance keep up with inflation? Yeah, of course it can. It's all a matter of how you depend it. Now, Steve, just for a little fun for everybody over here. Now, when you look at the contract premium and the premium outlay, it's $12,000, and then all of a sudden in year 32, it drops down to what?
Down to 11,463.
And then in year 36, it's dropping down to
98.39.
And then the year after that, it's 9,303. Now,
Yep.
How do you explain that? What's that all about?
Well, you're reducing your paid up and you're getting more to the base.
Well,
And
you know what Nelson Nash would say? Nelson Nash would say the reason it's going down is because of the government, right?
that's right.
All that the system does over here is helping you not create a mech. So it's automatically reducing the premium to prevent this from becoming a mech. That's how powerful this is. That's how the life insurance companies work in order to make sure that you can have this in all its glory, in all its tax advantages that life insurance provides. All right. So now here we are. Guess what? You're still alive 40 years later. How much did we pay in premiums? Well, we paid approximately 12,000 times 40, right? But we see that it went down. So we paid a little less than 480,000. And what's our cash value in year 40? 1.245 million. All right. Everybody with me? All right. So now life insurance is first and foremost a death benefit. But if you're still alive, what are you able to do? Well, it can become a deferred asset. So let's take a retirement income. So Steve, I'm an easygoing guy, and I would say if you're sitting on 1.245 million at age 40, in year 40, why don't we just take 5% of that roughly? So we're just going to take 5%. So how much are we taking out here?
60,000.
Why is there a negative sign before the 60?
Because that's what's coming out of our net cash outlay.
That's right, because that's what's coming out. Anything that doesn't have a minus sign is what's going in. The minus sign is what's coming out. That's what's being distributed. So think about this. I'll go back to that question a little bit later if we're still excited about that. So what we're going to do is we're going to take a retirement income, right, of 60,000. And now I'm showing you now. So we're going to take 60,000 for 30 years. So Steve, I hope your son, I hope I didn't send you to the bad school here, but 30 times 60,000 equals how much?
$1.8 million.
1.8 million. So you took out $1.8 million. And how did you receive that?
I received that tax-free.
Tax-free? Are you going to get a 1099 from the life insurance company?
No, I'm not.
Are you going to have any of that money reported to the IRS?
No, I'm not.
Nothing. So think about this. You took out 1.8 million. What did you start with again?
Started with just less than 480,000 that I put in.
That's it. You had 1.245 million, whatever. The company, because of dividends in our low dividend paying product, is continue to pay that, so that at age 100, 70 years into the contract, whatever, you still have 539,000 and a net death benefit of 774,000. Wow. Pretty incredible. Pretty incredible. This is exactly what we wanted it to do. So think about it. You paid in $1,000 a month, and now you can take out $5,000 a month or more. It's up to you what you want to take out. And how do you get that 5,000 again, Steve? I forget what you said.
You take it, withdraw it. You take it out tax-free.
Tax-free. Tax-free. Think about that. Think of the advantages. But guess what? That's not the reason mom and I wanted to do this for you, Steve. We believe that life insurance is a current asset and should be used as a current asset. So what we're going to do, this was the story I always told. This is what we're going to do. Mom and I are going to buy you a brand new car. We're going to give you this car for you, your wife, and for our grandson, right? And the reason we're going to give it to you is because you're going to promise us that come hell or high water, as they used to say in my day when I was a boy, you would continue to pay that premium no matter what happened. Come hell or high water, that premium is going to get paid into this policy. So, Steve, after 5 years, what's your net cash surrender value 5 years after putting
$51,089.
You're sitting on 51,000 there, right? So
Right.
what we want to do is you want to go down to the dealership. You go down to the Toyota dealership in that town of yours where you live. You're gonna trade in the car, and whatever, they're gonna give you 25,000 there for that car you traded in. So you're gonna use that to buy the best car that you could possibly be at the time. And 10 years ago, for 25,000, you get a pretty good car. I don't know about now. You may not even be able to walk off the lot without a real banged up used one, but God help us here. So what I want you to do is I want you to go down. You're going to do this. So once you find out the car that you want, I want you to call the life insurance company and tell them that you need $25,000. Now, what's the life insurance company going to do once you give them a call? Tell them that you want to take a policy loan of 25,000.
They're going to send you a check overnight or deposit it in your account, tax-free.
Well, that's it. They're not going to ask you any question about what you're going to do with it. The one question they're going to ask you is, excuse me, Mr. Smith, would you like us to deposit? Is your bank routing number the same as that we have on record? If it is, we'll just put it in your bank account either later today or tomorrow morning. That's it. You go down there, you go down to the dealership, you give them the $25,000, you drive off the account. You drive off the lot. But you know what I want you to do? I want you to buy those cars. I want you to trade it in every 5 years. So every 5 years, you're going to do this for the next 35 years, right? So you're going to buy a car for $25,000, but not repay the loan. You'll just let it build up, right? Don't pay back the loan. That's what I want you to see. So now this is what we're going to do. You bought your cars. You haven't paid back the loan. So if you are in that situation and the dividends are based on the same dividend scale that we have here, projecting out, your net cash surrender value is going to be in year 40.
767,000.
767,000. What is your total loan?
477,000.
477,000. What's your death benefit? Net death benefit
is 1.6 million.
1.6 million. So that's pretty good, right? So think about this. The total premiums you paid in are 466,453 minus the total loans because you took $725,000 loans or 175,000. So what's the net you paid into the policy, Steve?
289,453.
That's it. That's your cost basis. That's what you have in there, right? 289,000. So you paid in 289,000. What is your cash value in year 40?
767,000.
How much did the cars cost you?
25,000 each every 5 years.
Oh man, son, son, you're a lot smarter than a lot of people I know. But let me tell the audience here, when I would do this presentation on the East Coast, people would say, oh, well, the cars didn't cost you, the cars cost you nothing, right? You're sitting on 767,000. If I went to the West Coast, I said, well, how much did the cars cost? Oh, well, they didn't cost you anything. You have 767,000. If I went to the Midwest or the South, what would they say? Oh, they would say, well, the cars cost you 175,000. All right. Well, I said, yeah, that's getting closer, but that's still not the correct answer. What did the cars actually cost you? And this is the best demonstration I know of how to show it. There's another number on this page, Steve, my son, of what those cars really cost. Do you know what that number is?
I do. I
You
think
might.
I do.
Well, why don't you say it out loud here? That's it.
Well, it would be the difference between the 477 and 289.
No, the cars
No?
actually cost you exactly $477,729. Because if you took $725,000 loans at 5% interest on the schedule that we took out, that total loan would grow to what? Oh, it grew to 477,000. Right? Now let me ask you this, Steve. Is that 477,000 some kind of, how should I say this since this is being recorded? Some bullshit life insurance hypothetical fantasy number there? Or is that a real number?
That's a real number.
Oh yeah. Oh yeah. Let me tell you, I promise you those cars did cost you exactly $477,729. Right? And how can I prove it to you? It's as simple as this. If you add up the cash value in year 40, 767,355, plus the total loan value in year 40, 477,729, what does it add up to? Anybody good and with arithmetic in the audience here? If you add up those two numbers, what are they going to add up to? Well, let me make it easy for you. Those are the numbers. If you add them up, what do they add up to exactly?
1.245 million.
They add up to 1.245 million. And where have you seen that number before? Oh, yeah. That's exactly what you would have had if you did not take those loans. Oh my God. So that's a real number. Oh, that's almost like what we would call opportunity cost when we borrow money and pay it back to somebody else who isn't ours because we're never going to see that money again. Once we pay that loan principal and loan interest to somebody else, guess what happens? That money is consumed, gone, lost forever. You're never going to earn interest on that again. Think about that. That's the number. That is a real number. So what would I want my son to say? Steve, what would I want you to say? Would you rather have 1.245 million or would you rather have 767,000?
I'd rather have 1.2 million.
Well, I think, well, thank God he said that. Yes, absolutely. I'd rather have 1.245 million, right?
Right.
So how do I get it back? It's the simplest thing in the world. You buy the cars and you pay back the loans. It's as simple as that. So lots of times, and I don't know about my our audience, Steve, looking at this, if they've seen this kind of stuff done on illustrations before. I have to tell you, 20 years ago, we didn't used to see this at all. So this is one thing that really works out nicely. So you can see it visualized here. So what we're going to do is you're going to take the car down to the dealership. You're going to trade it in. You're going to buy a $25,000 car. You're sitting on $51,089 as your net cash surrender value. You're going to repay that loan, and you're going to repay that loan over the next 5 years, right? Because what you're going to do, because you're going to buy a new car, right? You got to, we want you to drive around on a new car. But over here, just for fun, what happens in year 6? You take an annual loan for $25,000. The annual loan interest is 5%. 5% of 25,000 is what?
1,250.
1,250 there. Hold it. And there's no loan repayment. And what happens if you don't start repaying the loan? What happens to that interest at the end of the 12-month policy loan anniversary? Well, guess what? The loan interest accrues to the balance, to the loan principal. So now you're sitting on a 26,250. Now, Steve, if you took a loan from the Toyota dealership down the road from you, when would you have to start paying that loan back?
The next month.
The next month, immediately. Think about that. You'd have to pay it back immediately. Why do people want to become their own banker? Well, they want to become their own banker because who do they want to be in control? They want to be in control. You want to be in control. That's the whole purpose of this thing. You're in control when you take a policy loan. Does the life insurance company give you a schedule to pay it back? No. Right? Do they tell you have to pay it back at all? No. Right? Think about that. That's why I left it blank there. Could I have started paying it back right away? Well, of course I could, right? So think about this. So I'm going to start repaying that $26,250 over the course of the next 4 years because I want to be paid up. So in order to do that, I at 5% interest and do it over a 4-year period. And I did it the Marty Smith method, Steve, because I don't have to make things perfect, because guess what in life? Nothing's perfect. So I'm going to pay $600 a month. 600 times 12 is how much?
7,200.
7,200. So I'm going to pay back 72, 72, 72, and then 6,555, right? So if I add that up, how much does it cost to repay the first loan? It costs $28,155. So the question is, all right, okay. And then over there, you see on the screen under total loan in year 10, it's 0, right? Because we paid it all off, right? So what did you pay in loan interest, right? That would be the key thing. That's what everybody's worried about. How much am I paying in interest? Oh, it was a 5% loan, right? So the total loan repaid was $28,155 minus the original loan, $25,000. The loan interest is $3,155. Well, wait a second. Marty, this can't be right. You said that it was 5% interest, right? Yeah, 5% is only the rate of interest. The actual amount of interest that you paid is $3,155. 3,155 divided by 28,155. You're paying 11, right? You're paying 11%, 11 to 12% of your repayment as interest, right? 5% is just the rate. The more important thing always when you're taking a loan is to understand the volume. What's the volume of interest that you're paying, right? People don't get it. This is the volume of interest that you're paying, okay? So now, once we figure that out, what do you actually pay to the life insurance company? What is your net cash outlay? So in year 6, what are we going to do? Well, what did you promise mom and dad, Steve? You promised that you were going to pay the premium, correct? Right?
Correct.
Right? All right. So you're going to pay the premium, but you got a $25,000 loan. So what's that negative 13 under net cash outlay? Well, that's the difference, right? right? They gave you minus 25,000. You gave them 12. So to the life insurance company, it looks like, oh, well, Steve gave us minus $13,000. All right.
Mhm.
Understood that. Now, what about in year
Yeah.
7? In year 7, you paid the 12,000 plus you paid the 7,260. If you add those two together, what do they add up to?
19,200.
19,200. That's the way it is. So we're going to do that. So if you look at years 7 through 9, it's 19,2, 19,2, 19,2, and year 10, it's 12 plus 6,555 is 18,555. If you add up those 5 years, right? Minus 13 plus 19,2 plus 19,2 plus 19,2 plus 18,555. What does that add up to? Oh, so your total net cash outlay. And if you don't believe me, you better get out your calculators and start adding those numbers up because it's 63,155. So what did you pay in premium, Steve?
60,000.
What's the difference between 63,155 and 60,000?
3,155.
And where have you seen that number before? Where is it? Where is it, baby? It's right there. It's the loan interest, right? That's all it is. It's the loan interest. That'll get your eyes going crazy here, right? So that's the difference. So what is your out-of-pocket cost to the life insurance company? It's the premium plus the loan interest. And so if you do that, and you do that every year that we've taken a loan, if you take a $25,000 loan every 5 years for 35 years, and then repay the loan principal plus the loan interest every 5 years, what are you going to end up with? Steve, what do we end up with?
$1.245 million.
And where have you seen that number before?
The original one with the cash value.
That's right. That's what you would have had. Again, anytime you repay the loan at any point in time, the entire loan principal, the entire loan interest, plus the growth in the contract shows back up where in the contract, right?
Contract.
So you've restored the contract. Every year there's a zero under total loan. That number is what's exactly what would have been in the contract if the dividends would have stayed the same all throughout that. So think about that. Son, that's how you get it back. So what is the cash value after paying back all the loans? I'll just repeat it. It's the 1.245. So this is what, if you want to become your own banker, you have to understand. By repaying the $175,000 loan principal and approximately $22,085 in total loan interest, you get back $477,729 in your pocket. And what are you going to do with that once you get it back? Are you going to take your tax favored retirement? This illustration shows you putting it all together. It shows you taking the loans, repaying the loans, and then taking that supplemental passive retirement tax-free income. And that's how it works, right? There's my number. That's how it works. Steve, do we have any questions?
We do, Marty. It's first of all, great presentation. Thank you very much. Someone asked more of a product question. The question was, why is the dividend so low? It looked like it was less than 1% the first year. If one of you could just address that for us.
Yeah, I can address it for you. That's because it's all in this particular product design. It's all in the guarantees. It's all on the guaranteed side of the ledger, right? That's how it really works there. You could have a higher pay. Let's say Security Mutual has our LP100. Our LP100 is designed to look like most traditional whole life products with higher dividends. This particular product put instead of having it in the dividends, it was put into the guarantees. So there's less dividend dependence on this working. So let me ask you this. Steve, you'll like this story. I think I've told it to you many times there. Years ago, somebody was looking at a Northwestern Mutual policy illustration versus a Security Mutual Life illustration. And the agent I was dealing with said, Marty, here, I'm sitting with your illustration and the Northwestern illustration. And I'm looking at them and I'm thinking to myself, God, what the hell's the matter with Security Mutual? Where are the dividends? How come the dividends are so low? And I said, yeah, you're right. Yeah. I mean, does your client like a lot of dividends? Oh, yeah, they like a lot of dividends. Well, let me ask you this. In the 10th year, right, the premium's the same, the death benefit's just about the same exactly, but the dividends are much higher on the Northwestern side, mutual side of the thing. So I said, as I looked at the illustration, I said, well, what is Northwestern Mutual's cash value in year 10? They said, oh, it's 33,000. I said, okay. I said, what's Security Mutual's total surrender value in year 10? And there was a pause because the answer was, it was the same damn 33,000, right? So at that point in time, I said, that's right. Northwestern Mutual, they tout their dividends. That's something that they do, and good for them. I mean, that's the way their actuaries have created it. But guess what? You can't always look at the dividends and compare dividends because products are designed differently. Actuaries design products to do different things. So that I would say to you, when you're looking at different companies and you're making comparisons like that, what do you have to lay down next to each other? You need to lay down the tabular detail of those illustrations. And there's only really 4 columns. What are you paying in premium? What's the total death benefit? And then what is the guaranteed total surrender value? What is the non-guaranteed total surrender value? And what's the total death benefit? That's the only way to do it. Dividends are going to be immaterial because you don't know what the actuaries have done. Think about this. The higher the dividend, the more dividend dependent the other company is. The client, the policy owner is more dependent on those dividends always being paid. If you have more of your cash value in guarantees, it's less dividend dependent. What would you prefer? That's my question. So answer me that question and it'll give you your answer that you're looking for. All right.
Marty, going through the questions here. Next one is, what is the guaranteed rate at Security Mutual?
The basis of computation rate for all our current products is 3.75. Used to be 4%. They allowed the companies to go anywhere below 4 down to 2%. Security Mutual kept it so that it would be relatively close. The closer you are to 4, the closer your premiums are going to be to what they were before. There'll just be a slight increase like that. If you go down to 2%, Steve, maybe you want to tell what happens with the 10-pay product. The difference between having, everybody listen to this. The difference between having instead of having a 3.75 basis of computation rate versus a 2% computation rate. Steve, how would you answer that?
So what that'll allow you to do, and you'll see this in product variations. So the lower your computation rate, or what they call our 375, the lower you make that, you can put in more cash value, but then your guarantee goes way down for the amount of premium you put in, and then it's more dependent on, as Marty would say, the dividend. We believe that whole life should be focused on guarantees. So that's our philosophical, that's our company thing. We can refute, but we believe in strong guarantees, strong death benefit. So when you illustrate these, even if the client had to take out on our examples on the guaranteed side, it's not that much different than what they're taking on the current. So there's more probability that will come true. And that's really kind of a long way of answering your question.
The other thing I would say about that is Security Mutual, let's say it was $1 million policy, whatever face amount, If they have a 2% versus the 3.75%, our premium would be 38,000. Their premium would be what? 72,000? I mean, come on. You have the choice of buying a 10-year $1 million policy for 38,000 or 72,000. What are you going to do? What would you rather pay? From a pure life insurance point of view, you'd want to pay the 38. But also think about this. What if how does Security Mutual compete against that? Well, we would put the difference from 72 to 38 into the paid up additions rider and add that to our premium. So you would pay the same. And where are you going to have the greater cash value? Where are you going to have the greater death benefit?
Correct, with Security Mutual.
With Security Mutual, you see how it works now with the paid up additions rider. You add that paid up additions rider, and that death benefit is going to grow. It's going to grow so fast. The underwriters are going to say, "Guess what? You can't design a policy like this because you can't qualify for the amount of death benefit that you're gonna have in that policy." That's how powerful adding paid up addition rider to your base premium policy is going to work. And that's why people do it. That's why hundreds of millions of dollars are going into these types of banking type policy, into these types of capitalized whole life policies. People who want to become their own banker, once they understand that they can use the current cash value, access it tax-free, and all the other advantages that it has, that's why they want to do this type of sale. That's why they want to do it. That's why they want to have this. They want to put people in control. Because where's the best place to store your money? Where's the best place to store your money? If you compare a bank to a life insurance, a dividend paying whole life insurance policy, where's the best place to put it? Obviously, hands down, without even thinking, it's in the whole life insurance policy. That is the best money storage system that's ever created because it's a lifelong cash flow, money management, savings, protection, acquisition and financing, and wealth creation system. That's how this works. Now, is there anybody out there who sees these illustrations and wouldn't want to do this for themselves or for their client? Is there anybody that thinks taking a loan or getting, I could get like 0% financing or something, or or I'd be better off paying cash? Becoming your own banker is the third way to do this. You can pay loans, you pay loan interest, you pay loan principal, whatever. What happens when you pay a loan? You go back to zero. You can save your money, get to that point, and then pay it. It's the worst day and the best day, because what happens once you buy the thing that you want? Well, you go back down to zero too. Mm-hmm. Is there a third way to finance? Is there a third way to buy things throughout your whole life? And there is. It's called becoming your own banker. It's using dividend paying whole life insurance. Now, I've got another little presentation about that, but I don't know, Steve. I don't know if you pay me enough money to do this. I don't know. I don't know if you're paying me enough to show this crowd here. If there are any doubters, then we need to do another meeting. That's it. But
Marty,
certainly,
Marty, Steve, we have a few more questions here. Next one going down the list here, age limits, and then minimum face, and then underwriting, full or accelerated.
Oh, Steve, why don't you talk about that? We have a brand new program that came out. What do we call it?
So we have
CARES?
We have a CARE program. So we have a brand new program that is actually, so far, it's been working about 70% of our cases. Just started in September 1st, where we're looking at a holistic approach. And we're able to move cases, 2 to 4 tables up to our auto bind limit. And there's no product limitations or age limitations. It's just whatever our auto bind is. So unlike a table reduction program where you got cut off at age 70 and a certain face amount, this is auto bind. And so far we've been able to see, 2 to 3 tables in the higher rated cases and higher ages. So we're excited about that. Our express underwriting, if you're asking about that, where they, as long as they've seen a doctor within the last year, had an exam, or been in contact with a physician with the last 2 years, is up to age 60. No, actually up to age 70 now. up to $10 million. That's our kind of what we would call express underwriting. So we got a couple different programs, but that's our underwriting side of it.
What's minimum face amount for the whole life product?
25,000 for the LP 100. Normally it's 100,000 for the 10 pay, the LP 65, and the 121. So
Age limits, max age limit.
85.
85.
Next question. Thank you. Next question here. Based on your design, is the client better off paying a higher premium for 7 to 10 years than paying premiums over a lifetime? Are they better off paying 7 to 10 years than paying a premium over a lifetime? Short pay versus a full pay.
Oh. Well, the question is, money's got to be put somewhere. If you need a lifelong cash flow, money management, savings protection, acquisition financing, and wealth creation system, you can put your money in the bank and you can get, oh, what do you get? Oh, what does the bank pay you? Oh, interest? Yeah. Do you have to pay taxes on that interest? Do you ever have to pay taxes on your cash values that grow inside your contract? Never. Where is the best place to store your money? This is the basic foundational question that you need to have with yourself and with your clients. Where is the best place to store your money over your lifetime? So the question for me is, when people think, hey, well, I just want to pay this for a limited amount of time. The reason you want to pay it for a limited amount of time is because you don't understand what dividend paying whole life insurance is, what it can do for you, that it's an asset, it's not an expense. Let me ask you this. How much does life insurance cost? You know what? You know what Nelson Nash would say? You know what Nelly would say over here? Nelson, people say, well, Nelson, how much is it? But it's expensive. What do you listen to, Dave Ramsey or Susie Orman back in the day? It's like life insurance, whole life insurance costs nothing. As he would say with his Georgia drawl, it costs nothing. Because guess what? Even with our 10 pay, best class, all base premium, you put in 3 premiums. By the time you put in that 3rd premium, the entire premium shows up as cash value. Right? If on a cumulative base, if I give you, if over here, well, I guess I shouldn't have shut down this system here to show you that illustration. Within a few years, if I give the company $12,000 and 12,000 shows up in my contract, how much did the life insurance cost me? Who's paying the premium? If I give you $12,000 and you say, oh, well, here's $12,100 in additional into your cash value this year, as soon as I pay that premium, who's paying for the insurance? Right? We sell a product that's amazing. It costs nothing. People who don't understand that concept need to be re-educated. You need to re-educate yourself about how much does life insurance cost? It costs dividend paying cash value whole life insurance costs nothing. And that's going to happen with practically every whole life contract, including all base contracts at some point in time. You put in the premium, all of it shows up. On a cumulative basis, it's always, it'll break even again. So how much does it really cost you? And then if you understand how to use it as a financing and an acquisition tool, what could be better? My life completely changed after I met Nelson Nash. After I read that book, I was transformed. I came home from the conference I was at where I met Nelson Nash. I stopped putting money into the 401k and I started putting all my money I could into life insurance, whole life insurance policies. It's the best storage system ever created. Should you continue to pay premiums? Yeah. That's why I showed you trying to pay the 12,000 all years. Why would I not want to do that? Right? The only thing I would do is Nelson Nash, when I met Nelson Nash, he owned 43 life insurance policies on himself, on his spouse, on his adult children, all his grandchildren. And since he was such an entrepreneur, he owed them on every business partner he had because he wanted all his money to flow through that life insurance contract, right? Because of the way that it works. Think about this. There's a zero line. There's a zero line. You take a loan, you go below zero, you repay the loan. Where do you end up? Zero.
Zero.
If you pay cash for something, you got to save it. It gets to that high point, and then what happens when you buy it? Well, you get the object of your desire, but boom, you go down to zero. If you take a policy loan and you plot that exponential line of growth of the cash value in any dividend paying whole life insurance policy, and you take a policy loan and you repay that loan principal and you repay the loan interest, where do you end up? You don't end up at zero. You end up back on that exponential line that's growing. If you can't see that right now, Steve, you're gonna have to invite Steve and I back to do another presentation. I'm just, if you don't see that right now, if you don't understand that, if you've seen these illustrations and you still have your doubts or you don't understand it or it's not visual enough, Steve and I will be happy to come back again and do some more to prove it to you.
Hey, Marty, last questions here.
Sure.
One is you can put your contact information up again, but the last question here, just to be mindful of everybody's time. If you were to take any money before year 7, would that create a modified endowment contract or a MEC?
Never. No, it wouldn't create a MEC. No, it doesn't work like that. All right. Let me see. Oh, hold on. Wait a second. Let me see over here. Take Steve. Let's do everybody a favor over here on a guaranteed basis for my 30-year-old, right? For you.
Yes.
What was your cash value in year 3?
In year 3, it was 24,197.
You paid $12,000. What happens the very same day? What's your cash
It goes
value?
up to 36,506.
$300 go into the contract there. How much does the life insurance cost you? Who's paying for the insurance? That's my question to everybody. Who's paying for that insurance, right? This is my number. You want to call me up? You want to send me an email? I'm happy to do that. Steve, I don't have your stuff here. Sorry about that. But think about this. You better be reading this book there if you give me a call.
Fantastic.
It's going to be
Steve,
the best thing that you've ever done in your life. That's all.
Marty,
I
Steve,
can say.
thank you guys so much.
You're welcome.
Everybody that did attend this call today, it was recorded, and I will be sharing that with everybody. I have a copy of the presentation as well that we can share. But Marty shared his contact information. Again, from Best Agency, we look forward to helping you place these cases. And any questions you might have, we're also here for support. So without further ado, last question came in at the last second here. Do you have product available in all states?
Yes, we do. And in the Virgin Islands.
Yeah.
Yeah.
Fantastic. Is that your territory, Steve? That'd be great. Great place to go.
I wish so. It is my territory, but they don't let me go there. So
Too funny. Too funny. Again, I want to thank everybody for attending today. Marty, Steve, thank you guys so much.
You're welcome.
Fantastic presentation. And look forward to hearing you next time. Take care,
Very
everyone.
good.
Have a good day.
thank you.
Thanks
Marty.
a lot.
Thank you.
Okay.